Welcome back to my channel, Balance Sheets Matter. In this video, I'm going to be going over FactSet research and do a stock analysis on them. Now, FactSet has previously been a very high quality company, but has basically got caught in what's being called the SaaS apocalypse. And as you can see, the stock has basically fallen precipitously. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos. So if you want to get good ideas on potential stocks to buy, value traps to avoid, just like looking at individual stocks in general, make sure to subscribe to the channel. And if you do want me to look at a stock, leave it in the comments below. So now let's get into the analysis. So I think for FactSet, one of the first things we have to talk about and look at kind of is the AI headwind, which this is being largely interpreted as. And a lot of people think that basically with AI, it's going to wipe out all these software companies, which I think for the most part actually is not the case. And I'll kind of make this case in FactSet. So if we go into their investor presentation here, one of the things to understand is understand is who exactly are FactSet's clients. And you'll see they actually only have just over 9,000 clients globally. Well, at the same time, they do about 2.4 billion in revenue. And these are largely, wealth advisors and large institutions who are their clients. And on average, this works out to about $270,000 per client. And you have to think, well, maybe for the average person, $270,000 seems like a lot. But for them providing the sheer volume of data sets they basically provide, aggregated together, they're also basically implementing AI into their own workflow and the services they provide as well. It's really not that expensive if you're running a big hedge fund to spend $250,000 on the best data sets. This is not going to be something that they're going to be trying to build in-house themselves to get all these data sets and deal with all the potential problems with that. The one headwind that kind of really is a real thing is that with AI coming online, well, these basically institutions here and investment banks, for example, you see 75% of the top 50 global investment banks use FactSet basically, is you need less junior analysts, and therefore the user seat usage can drop. But that is one of the things with FactSet and these other software companies, they can and will basically just switch how the pricing works and maybe switched away basically from the user, the amount of seats that basically the institution's buying, and switching more to an API usage. So in the short term, while this does have the potential actually to slow down revenue a little bit, in the long term, I definitely don't think this is really the case. And we can actually see that they're really not actually being disrupted much at all, as if we go down to the guidance here, and you can see that, compared to previous years in the past, when we're looking at maybe 6%, organic growth, that is certainly on the lower side. But even in the last quarter, they actually have been raising guidance. So as AI has been improving, they're actually using AI to help, provide their, data basically better to their customers. And it's really actually not hurting the underlying fundamental business. And as I get into the analysis here, what I'll just kind of show is I think this is largely just a little bit of a re-rating of the stock price. And just at a certain point, companies do get to a certain size where they just can't grow at those past rates. And we can basically see here, looking at some of these top level metrics, the group focus value band kind of is showing this would be about the potential fair value for it, and looking like it could be very undervalued at this point. And I think as this analysis goes on, I'll kind of actually make the case that this may be a little bit actually accurate, this time in this case here. And we can see right now they are trading at a 14.35 PE with a lower PE of 11.51 because FactSet itself and analysts are projecting they are going to continue growing revenue in the future because their client base basically is very, very sticky. And probably the biggest risk they have is not losing clients, but losing seats the clients had before. But they can just change their pricing structure to basically accommodate for that going forward in the future as they implement AI features. I think if we go in here, you can actually see that, they basically, are using Claude and these other basically AIs out there to use on their back end for the data that's being provided to their end clients there. So this is one of the big things with the software companies is they're not going to be taken over by the AI. They're the ones that are actually going to use it. And there just might be a little shakeup in the future, not necessarily for FactSet, but for a lot of the other types of software companies of where the clients may settle as the underlying service, it kind of is going to be changing a lot for these companies going forward in the future. But getting back into the financials, basically, we can see that they do pay a dividend yield of 2.19%. It does have a low payout ratio of only 0.25, and they do have a reasonable dividend growth of close to 8%. And they have been doing, basically some share buybacks as well with shareholder yield of over 8% there. If we get into financials, you can see basically the last 10 years, they did have 9.6% revenue growth. And if we look on the right chart here, you can see the average revenue trend line, like I was saying previously, was at about 12%. And the green line here is projecting a combination of analysts and their own projections basically going forward. And well, you can see this is much lower than basically this, 12% line, and is maybe more in this 5 to 7%. So one thing you can also think of it this way is there is the potential tailwind and upside surprise that if they do re-accelerate their revenue growth basically going in the future, because if they can, really use AI themselves to provide superior data aggregation and superior tools to their clients, they actually may be able to raise prices several years down the road at a more accelerated rate than they are basically right now. And with that, you can also see, the EPS has been growing faster than revenue, as should be expected because they are basically buying back shares. And we get into the financials. One thing you can see with the slowed down revenue growth, basically the return on capital has been dropping. It's down to about 16%. This has actually been the case about since 2023 versus a lot of the previous years in the past. And we get into the income, you can basically see income's been growing nicely. And the gross margin, I would say basically has still been maintaining quite well up there. Well, since 10 years ago, it has dropped a little bit. You can see right now it's around 52% right now. And this is similar still to what it was back in 2018 to 2017. So I think they're still basically maintaining their pricing at the end of the day. And then we can also see on the operating margin, they seem to be maintaining the operating margin, just as well. And if we actually go back further, even when they had their gross margins a little bit higher percentage back in 2014, where it was 61%, their operating margin is still effectively at the same point. So this is a very good sign for basically FactSet, even though kind of with these little bit of headwinds and, shakeups with the AI market there, they haven't shown any signs that they're basically losing to their margins. And if anything, it's just a little bit slower on the growth compared to the past. And basically that's leaving them with about $750 million of operating income. They do have a little bit of interest. It's only 54 million. This is a very coverable ratio. I always talk about having at least a 1 to 10, and they definitely have over a 1 to 10 here. So that's a very healthy spot for them. And we can see basically, net income after their taxes, which they do pay a little bit of a lower tax rate, which is, kind of nice for them, I guess, because they are serving, clients and institutions that maybe have different structures in offshore in different countries. They don't need to charge, the revenue basically probably isn't being taxed as comparison to an all US revenue company, which is typically closer to 30% taxes. And that basically is leaving a, very healthy net margin of around almost 25% right now. And you can see over the long run, this actually has been pretty consistent. So we're, you're not really seeing any deterioration in the underlying business of them having to slash costs to keep customers, which again, for institutional clients, only 9,000 of them, and a relatively cheap product for an institutional wealth management fund of only 250,000 per year isn't something really they're going to be nickel and diming about. And that's basically kept them with pretty good EPS growth. They're at a little bit over $15 per share right now, because you can see basically they have been slowly buying back shares, although over the last several years, from 2019 to 2025, they actually really were not buying back any net shares. They're probably buying back a little bit to compensate for share-based compensation, but that's not something basically they were reducing their net share count. But in the last year, basically, they have started doing some more share buybacks. So the one also thing to kind of notice out of this is when the stock was a little bit on the higher side. Like if we go into the chart here, you look at these years and everything. I'll just go into weekly here. It's like 2020 to 2025 there. And they weren't buying back shares, but this was actually probably to the benefit because the stock was basically actually at our relatively high prices, will show from the valuations, and was more expensive. So this was actually probably pretty smart for them to not buy back a lot of shares. We get onto the balance sheet. From what I remember, the balance sheet basically is pretty clean. There's a little bit of goodwill from some acquisitions, sitting at a little bit over 1.3 billion. And their total equity is sitting at 2.1 billion. So they're sitting actually, if we take out the goodwill, a little bit under $1 billion. So, pretty normal kind of balance sheet there. They have 724 in current assets, slightly over the current liabilities of 506. So that's, showing they're keeping a pretty healthy, like, at least current assets. And for the long-term basically liabilities, we can see long-term debt. It is at a little bit under 1.4 billion, but they have paid this down back when they did an acquisition. It was $2 billion, and they did decide to actually pay this down. So this is, FactSet. They don't necessarily want to keep a lot of debt. Although you can see for the last few quarters, they really haven't been prioritizing paying down the debt. So I kind of doubt they're going to be focusing much on paying debt down on the future, unless they decide to do another acquisition in the future. Then at that point, they would also focus on paying down the debt. And probably paying down the debt and this acquisition is another reason that they weren't doing the share buybacks during this period of time. So that relatively, worked out pretty well for them. When we get onto the cash flow statement, one thing to look at is important is, look at the cash flow from depreciation, compare that to the purchase of plant, property, and equipment. And you can actually see that they are depreciating at a much faster rate. They're basically having to do any purchase of plant, property, and equipment. Because for a company like theirs, there's actually not very much to replace. But if we kind of do factor in that they do some spotty acquisitions over time, and you can see this one big one here for almost $2 billion. If we kind of average these out over the purchase of plant, property, and equipment, we probably would be, equaling it about in the long run. So I really wouldn't say that their income is being, understated because of this, due to the acquisitions basically they do. And anything probably going forward with development on the AI front is going to be expensed and, is not really considered a capital asset. So this really shouldn't be changing much. And then you can see based on the stock-based compensation, it's like, I guess for the company their size, this is like, a reasonable amount at, basically $70 million of stock-based compensation per year. And then we go a little bit further down on the cash flow statement, and you can basically see repurchase of stock here. A little bit of on the lower repurchase side, and they started ramping it up in the last year, especially at these lower prices. So, that is basically, nice to see they've been doing that. They weren't basically buying back stock when it was as expensive, and they've, started buying back more stock when it was cheaper. But I think that was mostly just due because they did the acquisition, here. So therefore, you kind of have to cut back on your share buybacks. Although they weren't doing as much between 2019 and 2021 either, but that might have been because they're preparing for this. And then they, took out basically a big net issuance of debt. And then the 2 years after, they tried to pay a good chunk of that down, which basically slowed down the buybacks as well. Although they basically have kept a steady dividend, increasing it at like, this nominal percent of around just under 8% per year, which you could probably expect going forward based on, their projected, growth trend. So anyways, like at the end of the day, they have close to $700 million of free cash flow. And when you kind of take out the dividends there of like, 160 or even, kind of factoring up to 200, they do have at least 500 million to basically be doing share repurchases. So I think the really big thing of why FactSet has gone down so much actually kind of just comes down to a valuation thing here, because I think basically they did get on the much more overvalued side. And you can kind of see, like, when they did ramp up, there was this sudden acceleration basically in the revenue trend, and the stock basically jumped up a lot. And now that is normalizing quite a bit. And you can see, like, from 2027 to 2028 here, they're only expected to grow. Oops, let's take that out there. About $150 million on $2.6 billion of income. So I think that is more in that, like, 6 to 7% range here. I can just kind of quickly check that. And 150 divided by that is 5.7. So the 6% revenue growth, a touch under. That's kind of what's being projected basically going forward, which definitely is on the slower side compared to in the past when they were kind of more at 10 and 11 back in this point here. And then if we do basically pop up the EPS estimate, one of the benefits of getting a little bit on the lower price side here is that you're able to buy back more shares. So companies that are very profitable like them are able to buy back more shares, and that actually does keep, therefore, the EPS growing actually at a faster trend, because you can see the EPS here is growing more instead at about 10%. That's like actually looking pretty good for them. But I think the real big thing is, what the problem with them was and why the stock has basically crashed so much is we just need to look at the PE. Maybe I just should refresh this page here after this because it keeps going back to the zoomed in view. And you can basically see back in kind of pre-2020, you can see basically the P ratio right here. On the high side, they would trade maybe about up to a 30, low 30s. On the low side, they were trading around 20. And this was basically pretty consistent. Going all the way back to 2000, basically 9, the great financial crisis, when we went down to a similar one of about 14, basically. But basically after that, for the longest time, they would trade from like, a 20 to a 30, which for something growing at the previous rate they basically were of revenue growth, a little bit over, around more 10%, that does make a lot of sense. So we have to think that, well, maybe it's going to be a little bit lower going forward in the future. So maybe rather than like, looking at, getting into the low 30s, you knock the P points of like, high teens up to high 20s. But then basically what happened when there was that little acceleration in the revenue trend kind of at 2020 and just a lot of crazy buying in general in the markets, you see what happened. The P ratio simply started going into the 30s and even into the 40s. And this is basically what happened with a lot of software companies. And frankly, it didn't make a lot of sense from a valuation perspective because the growth really wasn't in the long term justifying this type of trend. So then, like a lot of other stocks I've covered, such as like Lululemon recently, is they got really, really overpriced during this time as well. And when you get kind of an overextension in one phase in the uptrend there, you kind of are going to be tending to get an overextension then in the downtrend as well to kind of renormalize where the price would be. Because I don't think there's a reason that even though it's a high quality company, you really just don't justify this, 35 now or 30 to 45 P ratio. So basically, a lot of the decline of FactSet hasn't necessarily been because of this onslaught of like AI taking away their business as they see. They just have slightly lower growth compared to 5-10 years ago, and they came from a previously very overvalued state. So I think the stock very much could resume into that mid 20 PE ratio again in the future. And I'll just kind of show you with the estimate how that would look, because we can bring up the EPS estimate here, pop up 25. Have to get rid of that again and take off the PE. And you can see this is like actually 25 would maybe be a little bit on the higher side of a P for them in the future. I think before we say, oh, they're going up to the low 30s, maybe they're going to go up to 28, 29, not quite as high, but I still think they easily could trade, maybe average at a 20, maybe a little bit higher. I'm saying 25 is kind of like the higher side. And if they do actually accelerate in the future, you could see that 30 again. But you can kind of see how before the price of the stock kind of more did actually trade in line with this 25 PE, a little bit under, a little bit over. But then, coming up to 2020, it traded way, way over. Now we're way, way under. And if we were to revert back to this, there, is quite a significant upside, because this will kind of be implying that, the more the fair value of the stock is actually closer to, $400 at that type of P ratio. And even if you say that, okay, let's look at it a little bit lower, look at basically a 20 PE, there's still some significant upside to the stock. It's sitting at 224 right now. And you could say right now, therefore, the fair value is worth about 300 or something. But then also at the same time, this does make sense why the stocks dropped. Like when the stock was effectively about at closer to fair value, that could be interpreted at the end of last year. Well, it does make sense why it then did drop into the low 220s here, where it is definitely looking more attractive in my opinion. And we can do a couple other valuation methods here. Let's pop on the price to sales ratio. And you can see basically looking at the price to sales ratio, because the margins have been stable, like, pretty much this whole time. We're sitting at pretty much a record low price to sales ratio right now, going all the way back actually to 1998. So overall, this, company is looking very cheap. And again, it was this period here, they just really got on the higher side, because before it was like, okay, maybe the high price to sales ratio was a 7, and then suddenly, well, it's going up to 11. Well, that's just, kind of basically insane. And even these levels here was the whole time trading at an elevated basically multiple than it should have. So that's one of the reasons the stock has looked like it's basically dropped so much, because it just came off this really, really, really expensive valuation. And with that, we can basically jump into the trend. I basically have my longer term panel here, and usually a lot of time what happens when you get a trend like this and then it falls into the lower trend, you're going to proceed going in this lower trend in the future until there's basically another deceleration forward. And basically if we're talking that 25 is more of a fair PE that, does basically put, the more proper value, or a little, not fair value, but the slightly higher side value, what we would be targeting, that kind of does put this upper middle trend here kind of as the new target. So anyways, like if in the future, I already do own the stock, I have been picking up some shares, actually lower than the current prices now. I think it was around 210. If it, does drop, I'll, start buying a few more whenever I'm basically accumulating shares. And, what I would recommend, for kind of accumulation things, you just don't buy everything right away. You wait for things, because you can kind of see that if you look in the past here, like, 2009, this did, take actually quite a long time to bottom, pop back up and bottom again. And you never know exactly when the bottom is going to be. And these bottoms here, these take, significant amounts of time. We're talking, 2008 October to 2009 March. You got another period here, which was, July 2002 to March 2003. And, those are long bottoming periods. So, this stock FactSet here could be potentially, kind of bottoming for the rest of the year, and before it basically really, really takes off. But in the long term, I still do think, it's a good value, because I think it does present some reasonable upside. It does have basically its own type of good moat. And there all always is those potential tailwinds of some reacceleration of revenue in the future, once we start seeing how this basically AI pans out for the software companies that are actually the ones using the AI, providing it to their clients. So anyways, that's basically my analysis on FactSet. I think it is a pretty good stock, and a good one that I've been starting to accumulate. So if you like that analysis, make sure to like the video, subscribe to the channel, and I will see you in the next stock analysis.